Um, so today I want to talk to Sanjeev ji about passive losses. Now, those of you guys who own real estate, maybe you bought it as a secondary home, or maybe you bought it as an investment home, whether it's in state of California or a different state, there are certain things you can do to use your real estate for tax deductions. And I want to talk to Sanjeev ji today to kind of explain how that can work in your favor. So if you own any kind of real estate, you want to pay attention to this video. Now, those of you guys who don't know Sanjeev ji is a certified public accountant here in the state of California. He has 3 offices, one in Fremont, one in Pleasanton, and one in Sunnyvale. So you're always welcome to come to any of those offices, or you can always set up an appointment online just by going to sanjeevcpa.com. He can meet with you over Zoom and get all of your questions answered. Obviously, his clients are all over the world, so it doesn't matter whether you are in the United States or a different country, you can always connect with him. If you want to talk to me, I'm a licensed life insurance agent. My company is My Wealth Guards. You can go visit mywealthguards.com to learn more about me. But today, we want to talk to you about real estate. All right, Sanjeev ji, so I have lots of questions about real estate. I think real estate is a wonderful way to save taxes. Wouldn't you agree?
Yes, it's a wonderful way, but before you look at the real estate, we have to understand the definition of passive losses, passive activity and active activity. So if you're working hard, you're working as a W-2 employee, or you work in your business, and that W-2, you get a W-2 as a pay stub, like pay stub every month, every week, every 2 weeks. So that pay stub generates income for you based on your efforts. When you work for your business, the business generates profit based on your efforts. So that becomes active income. But if something is not, you're not working for something, and that something is generating income for you, that means you're not working hard for that income. That something is making money for you. When that happens, it's the money you invested. That investment is giving money, and that becomes a passive activity. So when it comes to taxes, it's really, really important to understand the passive loss rules, passive activity rules. I will not say passive loss. It can be passive income also. It can be passive loss also. So passive activity regulations are there. Now, when it comes to real estate, like I said, you have to understand the passive activity. So what happens is, real estate by definition is a passive. Means you don't do anything. You just buy real estate. You invest money in real estate. But real estate by its own means generates rental income, because you pay to tenant, you pay to others, it generates a rental income. And when you get the rental income, you're just collecting the rent. You're not doing anything else. You're not managing the real estate. You're not putting time into doing the repairs, looking for tenants, or advertising for the rental property. Of course, you do that, but you're not doing consistently, like managing the real estate, doing all the work to make it happen. So if that is the case, that becomes a passive activity. And when there is a passive activity, there are rules governing the losses. Now, when you have a passive income from the real estate, the passive income is totally different than passive losses. So understand that real estate, we have to go into the passive activity rules for the real estate and then move forward.
So Sanjeev ji, just so everybody understands, so you obviously made it very clear that real estate is passive activity. Can you give a couple of other examples of activities that would be passive as well?
Yes, so we do a lot of syndication now. A lot of people have done syndication last few years back. They have invested money in real estate, like for Dallas and other areas where people are doing multiplex units, buying properties, buying land, constructing buildings on that. You become an investor. They ask for money, let's say $50,000, $100,000 from different investors. You as an investor put that money. You become a part of their LLC, and that LLC invests money in the real estate, building that up. They generate the revenue, and they give you a K1 at the end of each year. And that K1 is just a share of your profit from that business. And that K1 is a passive, because you're not going there in Dallas and making this thing happen. So that's why it's important. So that's one example of K1. One example, passive activity. The other passive activity is like you investing in a stock market. If you invest in a stock market, the stock market generates either profit or loss, or the stocks that you invest in gives you dividends. And when that dividends comes, it's a qualified dividends. It's not you're not doing anything for the company. The company is generating revenue, profit, and based on the profit, they distribute dividends to the shareholders. So that's an example.
So there you go, guys. Now, a couple of things. Number one thing is, if you want to learn more about investment opportunities, One of the things Sanjeev ji and I do every single year is something called Wealth Summit. If you're not familiar with it, just go on sanjeevcpa.com and you can look at some of the past activities that we have done. So you can come to that summit and learn a lot of these opportunities that are happening. Obviously, right now we are in the month of February. This particular event typically takes place in December. So we still have some time when we will bring this to you guys, but just something to keep in mind. The other thing you can also do is connect with me on my WhatsApp group. So just go to mywealthguards.com and you can reach out to me from there, and I can add you to our WhatsApp group. So that way, whatever is happening, we can let you know about that as well. So you can kind of keep in tap if you want to learn about some of these opportunities that are out there. All right, so let's get back to passive activity. So Sanjeev ji, give me an example. So let's say I bought a rental home here in the state of California. How can that help me reduce my taxes?
It's a very broad question. I have to. I will make it simpler in simpler steps. So when you buy real estate, if you're not putting efforts to make to manage that real estate, then it becomes passive, like I said. And when that happens, if you have expenses, what type of rental expenses, like interest payment, property tax payments, cleaning maintenance, HOA fees, sometimes you have traveling to and for, like auto expenses, you're going from your home to that real estate to manage, or to not to manage, to collect the rent or look at the property, that also is an expense. Then the most important non-cash flow activity that happens in real estate, and why people invest in real estate, is known as depreciation. Depreciation is a non-cash item, which means you're not doing anything, you're not expensing it, you're not putting money to get depreciation. Depreciation is based on the building value of the property. How much is the building value? Let's say you bought a property, real estate, for 100,000. Of course, in California, it's not 100,000. You will not find anything, but you will find 1 million plus. But anyway, I'm just in as example. If you buy property for 100,000, 60 to 70% will be building, and 30 to 40% will be land, depending upon whether it's a condominium, townhome, a single family, multiple units. Based on that, you depreciate. If it's a residential, you depreciate the building value over 27.5 years. So 70% of 100,000, in your example, is 70,000. You depreciate 3% of that every year, 3 to 4%, 3.5%. That comes to around $8,000-9,000 roughly. So $8,000-9,000 of your income is not subject to taxes. That's saving taxes. That's one thing. Second thing is, because of depreciation generates losses. Because if you are paying high interest on that mortgage, or you're paying property tax, by the way, property tax is fully deductible as rental income. There's no limits like we have for primary home. So you can deduct the full interest. You can also deduct the full interest. There is no limitation on the rental property mortgage like we have in primary home, where the interest is limited up to $750,000 loan. In this case, it's fully deductible. Interest is fully deductible. Property tax is fully deductible. Because of that, you're not able to recoup it in terms of rental income. Generates losses. That losses will be carried forward. That's a hidden tax benefit. The loss is carried forward. Why is a hidden tax benefit? Because once the loss is carried forward, you can use that loss. The loss never get lost. You can use that loss in subsequent year when you sell the real estate, and if there's a gain on the real estate, the loss will be coming forward and setting up the gains. And if there's more losses than the gain, then that loss can be used to set off your other W2 income or other income. So it's the hidden tax benefit. That's why real estate becomes very important. Now, if you are managing the real estate, if you're a real estate professional, means you are putting more than 750 hours, your primary occupation is real estate management, and you're at a management, you're putting time into it, you're doing material participation regulations are there. If you're doing all those things, all those three factors, 750 hours or more, primary occupation, material participation regulations. So if you follow that and you're managing the real estate, you are a real estate licensed person, then that loss is that we have in our example, that loss, instead of being carried forward, it will be used, that loss, to set off your other income. So powerful tool. And then in that case also, you can treat that as a business activity. And when you treat that as a business activity, in addition to business rental expenses, you can also start booking business expenses, telephone, internet, whatnot. and do the 401k plans and better 401k plans. So that's why real estate has both the picture, passive losses and active losses, and that's where the definition comes. That's where the things come into picture.
So from taxes point of view, seems like real estate offers a lot of wonderful opportunities.
A lot of tax appreciation. When you have appreciation, capital gains, you're not subject to ordinary taxes. You're subject to special capital gains tax rate. Then your rental income, you don't pay taxes equal to depreciation claimed on the rental income. Third, you get full deduction of the expenses, like there is no limitation on interest and property tax payments. Fourth, it creates equity in the house. As you increase equity in the house, you can use that liquidity to borrow money from the banks and do more investment. So then, and last but not the least, it's like a security for you. You're living in your own house, or you're having the assets. You're creating assets surrounding you. So in terms when it's time for retirement, you can use those assets as income to supplement your other income. So that's how so important for real estate.
So and just to kind of clarify, Sanjeev kind of brought it up earlier as well. It works for both residential and commercial properties.
It works for both residential. Commercial properties is more about managing the commercial tenants. Of course, you need to have an experience of dealing with commercial tenants because the tenants will be big. They might be AAA tenants, rated tenants like Starbucks and Walgreens and whatnot. So the leasing agreements, the maintenance of those things, you need to really have to have an experience in dealing with commercial tenants. Of course, attorney will help, but the experience also helps. But residential is much more easier, much more better because we live in our own houses. We know the things surrounding them. But yeah, real estate is good for both.
Now, Sanjeev, I know many people who comes to our summit, they watch our webinars, they watch our videos, and there are quite a few people who kind of do taxes on their own, right? They go online on some of these tools, or perhaps even go to their local friend or family member who knows how to do taxes and kind of helps them out, right? So because they're not really reaching out to a tax professional for a very specific advice, is it possible for people to make mistakes around making these kind of calculations?
Oh, definitely. If you own real estate, of course, the expenses, you know it. Interest payment and property taxes, there's no brainer. You can deduct it. But what about the things like taking care of automobile expenses, which I just told you? And what about depreciation? How are you calculating depreciation? What's the method? Of course, the years are fixed, but building value, land value, you can do cost segregation analysis. So you can do all those things which a tax professional will tell you, and how to convert that passive to active, forming an LLC, forming an S corporation, surrounding it. So all those things are important area which they miss out when they do on the tax return. Their objective is to finish the taxes. If they have paid $450 or $500 or $700, they might have got their money saved in terms of planning for the future.
So, and the reason why I asked that question is if you own a real estate, it might be in your best interest to reach out to Sanjeev or whichever tax professional that you work with and kind of ask them a little bit more about how you can claim all your passive losses. Just make sure all the check boxes are checked in and you're taking the maximum deductions possible. Now, Sanjeev, I heard of this rule called $25,000 rule. What is this magic $25,000 has to do with anything?
So there's no magic of 25,000. It's a rule that says that if you're making total income, when I say total income, it consists of all your income from different sources like W-2, interest, dividends, capital gains, business income, retirement income, all those together. If the total income, we call it AGI, if the AGI is less than $150,000, it's less than 150, then you can claim the real estate losses, which we just said, that losses can be carried forward. Instead of carrying forward, if the AGI is less than 150K, you can deduct up to 25,000. So from 125K to 150K AGI, you can deduct full $25,000 over the period of 25,000 and the difference. So you can claim that. So if you make 130K, you can't claim 25,000 because you're going over the board of 125 by 5,000. So pro rata basis, you will calculate that one. If your AGI is less than 125K, you can claim 100% of $25,000 of the loss generated from the real estate you're not sold that real estate, but you created losses, like I said, from depreciation, other expenses. That if the loss is there like $6,000, $7,000, $9,000, or $10,000, you can claim that $10,000 against your W2 income. But to claim that one, you have to have total income less than 125K. If you have income between 125 to 150K, you can deduct 25,000 on a pro rata basis. But if you have income above 150K, you are without luck. You cannot claim any $25,000. You have to carry forward that loss which you just said.
And Sanjeevji, just to clarify, so when you say somebody's making less than 125, that would be their active income.
Total income.
Yeah, all their income, including active income.
Yeah, active income,
right?
Passive
so
income.
From your W2 and whatnot. Now, what Sanjeevji is saying is, look, if you make less than $125,000 and you have a W2 income of, let's say, $125,000, and you have passive losses from your real estate transactions, you can claim up to $25,000 on your tax return and get full deduction for that $25,000. And if you are between 125 to 150, it kind of prorates from there. I mean, that's a huge benefit. I mean, that's $25,000 you can write off on your tax return. I mean, what else can you do?
25,000 up to 25,000 of your actual losses.
Right, and what other activity can you do that can give you that kind of benefit? Right, so it's a great benefit, but then it also makes you think, how should you own a real estate? Right, because you have to really think about which people are owning the real estate, because this 125K rule can actually come in quite handy. And talking about how to own a real estate, we have a different video about that, so please do watch that. So you can kind of a little bit about should you set up an LLC? Should it be a California LLC, Nevada LLC? What's the best way to structure it from the tax point of view? We're not a law firm, so we cannot give you legal advice. But obviously, Sanjeevji can definitely tell you from a tax perspective what's a great way to do that. So I hope you find this video helpful. If you like it, please definitely share it with your friends and family members. If we can be of any help to you, please go to sanjeevcpa.com. And you can learn about all sorts of events. For example, we have an event coming up just next month. It's going to be a heavily focused tax event. We will be talking about strategies, just like passive losses. What other strategies that you can apply to reduce your taxable income? What can you do to make sure you're taking care of all the credits that are available? For example, there's an electrical vehicle credit that's very hot this year. Understanding how that works. People who have foreign income, or maybe they have assets in different countries, we'll talk about that. If you're a high income tax bracket, we will talk about some of the major strategies that can help you there. So it's going to be action packed. It's a half day event. We're going to start at 10 o'clock in the morning. We'll go around till 2:30. Lunch will be there. So please just go to sanjeevcpa.com, check out that seminar if you want to come, and we'll look forward to seeing you there. If you want to reach out to me, go to mywealthguards.com, and you can reach out to me. I can add you to WhatsApp group, keep you informed about all the things that is happening, of all the new events that are happening, new strategies that we work on. I can let you know about all those things. And then most importantly, if you have a question, if there is something that we did not cover, something I missed that I should have asked, please reach out to me. Let me know, hey, Deepak, can you please clarify this point? And I can always reach out to Sanjeevji, again, make another video and get that answer back to you guys. So once again, thank you so much for staying with us today. And I'll look forward to seeing you either on the next video or hopefully at a live event. Thank you.
Thank you.